Great. Well, I want to start, like Isuf, thanking Victor and all the organizers for really an outstanding conference. I've really enjoyed it. I've learned so much. So I'm presenting this paper where it's actually co-authored. And I'm very lucky because 3 of the co-authors are actually in the room. So any difficult questions can be addressed to them.
Good division of labor.
So it's with Bationo, with Victor, with Isuf, and with Judith. I think that there are 3 interesting features of the paper. And additionally, we have this nice title, which I must confess was invented by Victor, about the angel is in the detail, not the devil, which I think is very nice. So I think the first interesting characteristic is that we have a unique theoretical framework in which we combine 2 separate theoretical traditions, which are usually not combined, and apply them to Africa. One is a sort of more structuralist analysis of economies applied to Africa, which is associated in recent times with people like Danny Roderick, but that draws on a long tradition, going back to Arthur Lewis and others. And secondly is the literature on capital flows, which has to do with volatility, reversibility, and their link to crisis. So that's, I think, nice about that we try to apply both things, both traditions, and I want to talk a little bit more about that. Secondly, we have this marvelous hand-picked, unique database, which actually fits in this theoretical framework that I briefly mentioned, which looks both at the types of capital flows on the one hand and on the sectoral destiny of these flows. And there's very little availability of this data, which was gathered under Judith, and very little application of it to this method. And the third feature, I think, is that the results for us were a little bit unexpected. We were a bit surprised by the results. We didn't expect that, for example, FDI would have negative effects. We thought that maybe the more volatile capital flows had more negative effects. But in several sectors, we found that there were negative effects, and this was quite surprising. So turning to the theoretical framework, as I said, there are 2 important traditions, and merging them is quite novel. So the first tradition emphasizes that for successful development and growth and structural transformation, the role of increased productivity is crucial both in the sort of Arthur Lewis tradition of moving labor from traditional sectors to modern sectors which have higher productivity, which has actually been very successful in Africa. There has been a movement of people from typically agriculture to the more modern sectors. But there is also a movement, which is what happened in Asia, that in the more modern sectors, productivity continues to increase. So that on average, productivity rises throughout the economy. And this is what Danny Roderick and his co-authors stress has not happened so much in Africa. And therefore, there is this fear that it will not be able to take off in the same way that Asia did. Interestingly, Latin America is the opposite. There is increase of productivity in the modern sectors, but there isn't the same transfer of people to the more modern sector, partly because it's happened in the past. So that's the first tradition. And the second tradition, as I mentioned briefly, is the one that looks at capital flows and their development impact and stresses that although there are positive effects, there are also potential risks of volatility and reversibility, which can lead either to financial and macroeconomic instability But worse can lead to very developmentally costly crisis. And initially this was, for example, raised by people like Max Gordon, and then more recently people like Calvo, and I've been involved in that kind of analysis. More famously people like Stiglitz and Calvo and so on. So the key research question, and I should really be showing, oh, this is an ad for my book, which Leonci very kindly mentioned. It somehow got into the presentation.
The angel put it there.
Exactly. Okay. So, sorry. I'm going to flash. So the research questions are, if foreign capital flows are channeled to sectors which have higher productivity, that's modern sectors, than the rest of the economy, or to sectors where productivity is increasing more, then they will have positive effects. However, if foreign capital flows do not contribute sufficiently to productivity increases and are potentially reversible or subject to sudden stops, as Calvo calls them, they may cause crises which undermine growth. Therefore, both matter, both the sectoral destination of these capital flows, whether they go to these higher productivity sectors or with increasing productivity, and the nature of the flows, whether they're long-term, more stable, and more difficult to reverse, are important. And so we therefore ask, do they contribute more to productivity and growth, or do they risk undermining growth in the future? Which economic sectors are most affected and how? And are the effects dependent on the type of flows and the reversibility? And one other additional element from the literature, there's a nice paper by Gorton and Ordóñez who talks about good booms and bad booms. So he says credit booms, it talks more about domestic credit booms, but of course, as we just heard, aid flows and private flows are associated with credit booms domestically. He says about half the countries have long credit booms, but some of them finish well, which he calls good booms, because the productivity and the economic growth which they generate is sufficiently high to lead to a stable, higher level of output, and therefore helps avoid reversals of capital flows and crises. Whereas the bad booms are the ones where productivity increase is not sufficient, which makes the country more vulnerable. Yeah? Okay. So these are preliminary findings, and then I'll go into more detail. So we find basically that the angel is in the detail, that the effects of private capital flows in general on productivity and growth depend both on the recipient sectors, and we have 8 sectors, and on the type of flows. And our results suggest that FDI flows to the construction sector enhance total factor productivity. However, surprisingly a bit, FDI flows to the agriculture and infrastructure sectors are associated with a reduction of productivity. And we find this inverse relationship between capital flows and income growth in some sectors. Total capital flows induce contraction in infrastructure and trade, while FDI flows are associated with income contraction in infrastructure, trade, and extractive industry. And there have been a number of alternative empirical testing and different proxies which we have used, and they all are robust to the findings. So we use a sort of a solo model. the data is for 18 countries in Africa for the period 2006-2016. The reason it's 18 countries and not more is that we chose those that the data was considered best. We would have liked to have done more countries, but the sample was narrowed, for example, to exclude fragile states, where in spite of all the excellent work that Judith and her team did, the data is just not reliable enough, offshore centers and so on. And for us, the limiting constraint tended to be whether these countries had data for sectoral flows, because you get, in general, a lot of data on the aggregate impact on the economy in all sectors, but you get very little on sectoral flows, even for FDI. And these are the type of sectors. The productivity measures were also very tricky, because we would have liked to have growth rate of total factor productivity by sector and over the years, but this is not readily available, so we used proxies, which are not ideal, but that's the best we had. We had some data on growth rate of real per capita GDP. We had some data for some countries on total factor productivity and some on labor productivity. So this is quite a nice table, graph which shows how capital flows have increased by sector, and we see, of course, the really dramatic increase of capital flows to extractive industry. The others grow, but they grow much less. Agriculture is interesting because it grows more both for FDI and for total flows. And of course much slower for things like manufacturing, and particularly slower for services. So we have here some of the numbers, and we can see that, for example, for total capital flows at a significant level, the effects are negative for trade. Yeah, that's all. And this is for growth. If we look at FDI, we find that the effects are negative again for trade, for extractive industry, and that's it. There is no significant positive correlation. For total factor productivity, we have again negative effects for agriculture. We have here positive effects, which is interesting, in the construction sector. And then, for sectoral FDI flows and total factor productivity, we have again negative effects for agriculture, again positives, large positive effects for construction, and negative effects for infrastructure, which is really a little bit surprising. And so on. So the conclusion is, well, we say nice things about our paper, that we've pushed forward the frontiers of existing knowledge by looking at the effects of heterogeneous private capital flows on sectorial economic productivity and growth, and recognizing that they have different impact for different sectors. We had this fantastic hand-collected unique database, and the main results that stand out is the inverse relation between capital flows and income growth, with significant coefficients for the infrastructure and trade sectors for total capital flows, and significant effects for infrastructure, trade, and extractive sectors for FDI flows. This is all inverse. FDI flows in the construction sectors have, however, positive effects on total factor productivity, whereas FDI flows in agriculture and infrastructure have negative impact on productivity. The construction sector, we're trying to explain a little bit why there's a positive effect. And we think that maybe it's because the high level of technology incorporated and helps with productivity catch up. But of course, I would have expected this also to happen, for example, in the industrial sector or even in extractives, but that doesn't show. Our findings are, as I said, robust. And I think the preliminary conclusion that we can take, and that goes a bit in the face of, I think, conventional thinking, is that African governments should be very cautious about encouraging capital flows, and indeed all capital flows, and that they may want to discourage excessive ones, as these may have net negative effects on their economies. But we accept, of course, that further research is needed. For example, maybe we're missing something about the long-term effects of capital flows, as well as more detail on the sectoral effects of different capital flows. And we would like to do more papers, hopefully with additional data, and would encourage other people as well if they find this an important case. But we think that maybe some of the so-called old-fashioned conditions that used to be attached to capital flows, particularly FDI, such as, for example, export performance and local content, should maybe be rethought by African governments so that they can try and channel the flows towards the sectors where there will be a bigger positive impact on growth and particularly on increased productivity. So that's the presentation.
Very good. Comments and questions? Oh my. Okay, good. You did well. So we have, let's start on this side and then we'll go to that side. Correct questions from this side first and then we'll go to that side.
Can you hear me? Yes. Excellent presentation. But there are some questions, serious questions. I mean, the construction result is just so, not just surprising, it's just, I just can't believe this, right? I mean, we see when, I just cannot see the mechanism. And if you don't have a theoretical mechanism to explain it, it's very hard. One can only think that it could be spurious because of the econometrics, right? And looking at the econometrics, as you did say, we've done robustness checks, and maybe one of your co-authors should explain what these are. But, you know, system GMM, with such small number of observations, we all know that system GMM is really so sensitive, and with the instruments and the lags and all the rest of it. So I was just thinking if you could do just something simpler in terms of the estimation, and what would the results show? Would they still be there? I'm also sort of surprised in some sense to see bank credit positive in the productivity equations, and very significant. It's a good result for the finance sort of angle, but it's just so hard to see that, you know, to believe those results, right? So you need to do a lot more to convince us that they are robust, or perhaps you should just try some other estimation method and come up with some more plausible results. Because I would agree with you that, you know, you would see I would expect to see the productivity results in industry, in infrastructure, in those sort of sectors, not in construction. I mean, construction is just, it's booms you're picking up. It's booms and busts, in fact, and it may be something to do with the frequency and the data. That's all. Thank you.
Okay, we'll take a couple more questions here. There are no, there is one here.
Thank you, Stephany. This is a really interesting paper. So my question is very simple and more for clarity. I want to ask, when you mentioned there is excessive FDI in the conclusion, what do you mean? Do you mean by the speed of FDI, or the amount, or the concentration of FDI in particular sector, or something else? Thank you.
Any other question here? There's one on next here, and then we'll take that one, and then we'll...
Okay, I think one of the alternatives maybe is to... Okay, one of the alternatives might be to use enterprise survey, the World Bank enterprise survey, because it has measures on the World Bank enterprise survey. We have done some work, and I'm not surprised that the FDI has no impact on productivity. At least we saw that on 142 countries. I think that you also escaped the notorious questions on JMM, which is no more useful anyway.
Okay, so we take a question from the gentleman over there.
Hi, Joe Tanega from University of Brussels. I'm really shocked by this paper. I don't know. It's like, if it's true,
Positive shock.
no, I'm just in disbelief. I've been like, wow. So if it's true, then lots of stuff that I believed has changed. And so I welcome that. But on the other side, I kind of feel that I'd like to see a little bit more about what you mean by channels and the methodology in which FDI could be used in a positive sense. Anyway, I want to thank you for shocking me.
Okay, so we're going to respond to this set of questions, then we'll come back for the second round.
So maybe what I should do is I should answer some of them and then leave the people who are more
Yeah.
expert. So on the econometrics, Yusuf, and on the data, Judith, and Victor, if you want to comment on anything. Is it on? Yeah.
No, it's not.
So, if as I said, if Yusuf wants to talk on the econometric and Judith on the data and Victor with all his overall wisdom. But I'd like to just pick up one or 2 points. I mean, Panicus, I think you've made very interesting comments. It is very surprising, the construction sector. It just occurred to me what I hadn't thought about when you were speaking, whether there isn't a price effect, because sometimes when you have a lot of capital flows and it goes into domestic credit, it could affect the prices of the property, which it doesn't mean that actually, real productivity has increased, but productivity measured by nominal prices. So there could be an element. I don't know how we would deal with that, but I think that may be an explanation. There is not a clear explanation why, but I mean, there is in the literature some analysis which shows that FDI has negative effects. There's a recent paper, for example, by MacDonald, and there have been other papers. Most papers show that FDI have positive effects on growth and so on, but there are some papers that show negative effects, and also that it depends on things like institutional features and depth of financial markets. This literature contributed to it, but I think it is still surprising. The question about excess of FDI, how do we define that in policy terms? I mean, I think that there are two issues always with capital flows. One is the absolute amount, as you say, and the other is direction of change. So I remember talking to the then governor of the Central Bank of Colombia, and he was worried basically about the direction of change, because he said we have an awful lot of FDI coming in, I think more into the extractive industry, and, he was a very pro-FDI guy, but said, it's just creating havoc with my exchange rate, and we're desperate. But how can I tell, a mainstream government can tell, the international community that I'm going to restrict FDI? And he posed it as a question. So I think there are problems, and a lot of African countries suddenly discover a lot of natural resources, or they think they discover, and then the money just pours in. And then via the kind of, as was pointed out in the previous presentations, via Dutch disease and so on, it has negative effects on the economy. I mean, I welcome very much this suggestion about enterprise surveys. And then finally, on the policy part, I mean, I'm maybe a little bit older than some people here, but in the 60s in Latin America and Africa and Asia, and indeed I think in much of the developed countries, there was a criteria of selectivity. So you encourage certain kinds of FDI, which you think are particularly beneficial for the domestic economy, and you don't encourage, or you could even discourage, FDI. I think for me a typical case is hamburgers, because if you introduce hamburgers into countries that have really nice food, like a lot of African countries do, you're actually deteriorating the quality, probably in terms of nutrition, but also particularly in terms of taste. So, why, I know that, for example, the World Bank has given meager guarantees for industries into hamburgers. So I would challenge that. I think that's not a good idea. But, if you're going to get value added in terms of technology, in terms of access to markets, or into local content or exports, yes, that's different. But recently, with possible exceptions, I think in Asia, countries don't think like that. Yeah? And maybe this kind of evidence would make us think about the need of returning to some degree of selectivity, even in FDI, that has gone sort of out of fashion. Because the traditional heads of FDI departments in governments, they go around the world telling everybody how fantastic the country is and how everybody has to invest there. We're great, and so please come. But maybe you have to rethink what a FDI department does. But so I don't know if Isuf, you want to talk a bit about the methodology?
Sure. Okay, yeah. Okay, thank you very much, Stephany, for this presentation. Thank us a lot for all these great comments. For those of you who have been shocked, don't be surprised, because people have been shocked also when we present it in Kenya, actually, okay, in Nairobi, I think, I remember when we presented in Nairobi, there were a lot of questions and so on. People were also, the result was surprising because people were not expecting that. And especially, when we present there, the policy makers and so on, because they are doing all this effort, to be able to attract foreign direct investment. Then when you come to them and say, okay, probably those foreign direct investment have negative impact, especially the agricultural sector and so on. They don't like they don't like really to hear this kind of story and so on. But basically, I think the main message, what we are really trying to tell here is not basically putting too much emphasis on the negative impact of foreign direct investment or capital flows on the economy. It's much more, really to say that capital flow do not have the same type of impact depending on the sector. This is really the main message we are trying to get it out. For example, if you take the agricultural sector, okay, and I look at from my experience with many of our countries, the negative impact is not that surprising. Look at where the capital flows are going in the agricultural sector. Usually it's not going to the production sector necessarily. Then if you look at it going sometimes through the commercialization, if you look at the value chain, it goes in terms of the commercialization part of it, not the production and so on. Then depending really on even if you look at those sectors where the money is going, then you can see that some of these results can be really, even strong. For the infrastructure, for example, when we present it, someone suggests he's not surprised by the negative impact, because if you look at the infrastructure, because there are a lot of money, there are a lot of corruption also in this sector also. Then you can think of all this political economy also being able to explain some of these issues and so on here. So. But of course, as I said, the main message we are trying to get out is basically the different impact depending on the sectors and so on, and then countries should be very careful about that. But in terms of econometrics, sure. Why? We really much more put up front. The GMM1 much more is because the persistent part of it actually. Because we really think that there is a persistence, and then we want to capture that. Of course, we have done. We did. The fixed effect. Control for a fixed effect regression and so on. The results still be sound, and also we for kind of aggregation. We for example, the labor. Productivity. We were able to compute. We cannot find the labor productivity for all the sector, but we were able to find it for some of them. Because we have three dimensions here, then we try also the hierarchical linear model, actually, which is used a lot when people study this kind of culture and so on and so on. And then we did this kind of analysis. Still, we have some kind of, I think the results are in line with what we found here, actually. Victor, you want to add,
Yeah, thank you. I just add something that basically it's interesting that there is both positive and negative effects. In fact, this addresses a long-running controversy known as the Lucas puzzle. It comes from the work of Robert Lucas in 1990, when he observed that international capital flows from developed countries to developing countries to be much smaller than what is predicted by the neoclassical growth theory. And that Lucas paradox has been around. A number of papers have researched this. So if you follow this trend of literature, there's, for example, a recent paper by Groniches and Gini. They find a negative correlation between capital inflows into developing countries, non-OECD countries, and the productivity growth. So they call this the capital allocation puzzle. And they warn about the elusive gains, the expected elusive gains of financial gains in terms of productivity and the welfare gains. So the sectoral decomposition is particularly important because it puts a finger on where the positive capital flows happen and where the negative capital flows happen and why. And the institutional issues here are particularly important. Maybe we need to drill down some of these and then carefully explain where they are negative and why, and then allude to the Lucas puzzle on the capital allocation, the 1990 paper. In fact, when there is emphasis, even by recent work by Prasad, that capital flows into developing countries are not only negatively correlated with productive growth, they also tend to be smaller in absolute terms. And I think what is possibly missing, is to see whether there is an implied a threshold effect. Okay, that because here the critique of the Lucas paradox is based on the fact that the level of the flows might be so small as expected that they may not be able actually to have an impact. So we be able to say at what level, or the approximate levels at which capital flows into a given sector may actually yield productivity, or whether the negative impact, as mentioned in the Lucas critique, puzzle obtain. So we have both results. We need to explain this very carefully. Yeah.
Okay, so we're going to take maybe. What? What did you say? What is it?
Can I have a quick comment on that? Is it 1 minute? Yeah. So I just wanted to comment on the question about, can it be true, right? As both Stephany and Victor have commented, there's a lot of variability in the FDI data. And I think one of the things that you have to think about when you look at this paper is that actually it asks a more constrained question, which is it looks at FDI in the post-crisis period to sub-Saharan Africa, obviously for the 18 countries where we had decent data. And I think that's quite a different question from if we look at the FDI literature more broadly, and particularly that includes FDI into Asia. So if you look, if you look back and you look at what FDI contributed to Asia, it was about the industrialization of Asia, I would argue. So I think if you look at that period in sub-Saharan Africa, we might be seeing something quite different with FDI. And you take something like the agricultural sector, right, where we saw negative effects on productivity. I don't think very much of the FDI that's gone into the agricultural sector is about something that pushes increases in productivity. It tends to be about extractive of raw products, right? And it's difficult to think of many examples which differ from that pattern. If you look at the infrastructure sector, the majority of those figures is about telecoms. This is only private flows, right? So it's about private investment in the telecom sector, and sub-Saharan Africa has been one of the key sectors where we've seen international private flows flowing into infrastructure development. And again, when you need to ask a question about what is the productivity impact of that particular type of FDI. So, if you look at it overall and just ask about FDI, it's maybe not very believable. But when you look at what we're seeing in FDI into Africa at the moment, I'm not sure that it is things that are particularly good for economic growth. And it kind of gels, these results do gel more with that more narrower question.
How about the construction?
I don't know what to make of the construction sector. I think it's quite interesting because we've seen enormous growth in lending to the real estate business, which is predominantly what this is, both from foreign investors, but of course from domestic banks as well. So when you look at the growth in domestic bank lending, and our database, by the way, includes that data as well. If obviously this paper did not use it, but it's there. The sectoral composition of the growth of credit actually is very interesting because a lot of it went into telecoms, it went into real estate booms in urban centres. It didn't go to manufacturing and agriculture. So, the question around the big gap in financing, which is really where we also came to this question, that both bank lending but also FDI still leave significant financing gaps in the key sectors for inclusive growth. So maybe if we start to think about it in that context, maybe it becomes a more believable story.
Okay, I'm going to do something unconventional. I'm going to allow questions, but the answers will come later if we save time. 2 questions. So 3 questions, and then we will take on after the last presentation.
Yes, I'm wondering whether the devil is not in the panel data. It's been very fashionable to look at panels, but we know there might be a lot of dispersion among countries. I agree you only look at 18 and not at 142, the other one mentioned. Don't look at 142. 18, but still, I mean, don't you have a few outliers, possibly in some sectors, driving the results? Maybe yes, maybe no. It could be part of the explanation. Second one is productivity, as we all know, is very difficult to measure. TFP is a measure of true technical progress and mismeasurement errors. So, okay, you also look at labor productivity. Well, I have a conjecture. I don't know whether it's has any value or not. When the Chinese do FDI into Africa in the construction sector, they bring in their companies, they bring in their workers. Do you think the workers are computed in the denominator of labor productivity? I believe not.
Okay, second question.
Thank you. My comment is more like a comment or a statement rather than a question. But I think there's quite a lot of potential in the database. I think that's really important because of the sector dimension. So the literature on FDI, of course, is a lot on at micro level, and there's quite a lot of strong evidence, I would suggest, that foreign firms are a bit more productive than domestically owned firms, even accounting for size and all the other things and so on. There's also quite a strong literature on vertical linkages, so spillovers through vertical linkages as well. Perhaps not so strong in terms of horizontal linkages. At a macro level, there's perhaps less evidence, consistent evidence, but at least it tends to be a bit more positive than perhaps you come out here. But I think your database can help to explore many of these issues. And if you are able to link, for example, your database on flows to the measures that Roderick and Macmillan have come up with based on University of Groningen data, that was also sort of funded by the DGRP, for example, that and you can get to the labor productivity at sector level. You can get to composition effects, you can get to productivity effects within sector, you can get to productivity effects through composition effects and also through inter-sectoral impacts as well. So there's quite a lot you can explore there, I think. So that's perhaps more like a statement. I think it's really good to sort of do more with this database and sort of bring this to the attention to lots of researchers and that they can explore what's in the data and do much more composition work there, similar to what Macmillan and Roderick did on transformation, and then think about determinants.
Last question has to be 30 seconds, no more.
Yeah, thank you. So my question relates to the measure of productivity. Basically, if you look at some of the African countries, you'll notice that even the growth rate in population is at times higher than the GDP growth on an annual basis. So if you're measuring productivity based on GDP per capita, I think there's a distortion in using that matrix. And also, in measuring labor productivity, are you actually using the number of people that are able to work, not as the population in totality?
Okay, so as I promised, we will not answer the questions. We'll take them on if we have to save some time at the end. Otherwise, it will be unfair for the last presentation. Thank you very much. We're going to move to the next one.